Welcome everybody to the High Return Real Estate Show. This is Jeff Schechter, aka Shecky, and got a very, very exciting episode for you today. Jack is actually on vacation, so I get the pleasure of doing this one myself, and we're bringing on a gentleman that has a tremendous amount of expertise in the self-storage business. And this is an area that has been very, very intriguing to me, and I really, really want to learn more about this because I think it's really a perfect dovetail into a lot of the conversations that we have about buy and hold investing. So we have an amazing gentleman on today that has a tremendous amount of experience in this area, and I get to pick his brain. So we are going to be right back talking to Kriss.
Welcome to the High Return Real Estate Show, the podcast for heavy hitters. 2 men, 1 mission. It's time to build your empire.
All right, welcome back everybody to the High Return Real Estate Show. I have an amazing guest today that his name is Kris Benson, and he's the Chief Investment Officer for Reliant Investments. And the bio that I'm reading off of right here says he's one of the top 30 commercial self-storage operators in the US in 2018. So that's says a lot. So you're obviously doing a lot of deals, Kriss, and I know that you like to do things a little bit different than most. And I just want to really know everything there is to know about self-storage in a short time format. So I'm gonna get into that brain of yours with like a pickaxe, if you don't mind. But welcome to the show. Happy to have you.
I appreciate it, Shecky. Thanks for having me. Looking forward to it.
Yeah, it's awesome. So tell me a little bit about your background before we get into the deep dive of self-storage. Like how did things start for you in the real estate investing world, and how did that evolve into self-storage?
Yeah, it's kind of a long winding path. So I'll try to keep it.
Isn't it always? Yeah.
It always seems to be. So my background really is in sales. So when I got out of college, I was in business-to-business sales. So I worked for a company called ADP, which probably some of your listeners know, a payroll company, sold B2B sales for a long time.
You want to hear something funny? I'm sorry to interrupt you.
No, not at all.
I used to own a payroll processing company in San Antonio.
Did you really?
Yeah. And so I competed with ADP and Paycheck. So I am very, very familiar with that.
I used to love when we would buy those companies, and those acquisitions would always be fantastic because we'd show up and, inherit 200, 300 payroll clients all at once. It was always fun.
Yeah. Yeah. We were targeted for buyouts a few times, and we were one of those jerks that just didn't want to sell.
Well, look, it was an incredible experience from a sales perspective. I mean, they do a really nice job of sort of the basics of sales. And I followed that path, kind of the corporate sales path for, after that, I got into medical devices. I worked for a company that used to be Tyco Healthcare, became a company called Covidien. And that company since was bought by Medtronic, which is a big conglomerate in the med device industry.
Yeah.
And from there, I started seeing in the operating rooms, I started seeing robots showing up. And there was a company called Intuitive Surgical that manufactured the Da Vinci robot, and went to work for them. Computer assisted surgery I knew was going to be the future. And I was there for almost 9 years. And right about when I started at Intuitive, there was a moment, Shecky, that I remember waking up and thinking, I can't do this for another 30 years. I was great money. Kind of when you start out, it's always about money, or at least it was for me. It was about hitting a number. And I did. And I was like, oh, well, that didn't really do anything. I think for me, what it was is as I got older, I realized that time was the piece I couldn't replace. So for me, it was about how do I build a path where I stopped trading my time for money, which I was pretty good at. I could work hard and make money. It was a question of, could I make my money make money? And so it started with a path that I think probably a lot of your listeners have followed, is the Rich Dad Poor Dad book, right? So yeah, story of passive income and assets versus liabilities was no different than that. That's what started it for me. And, when I started thinking about how I was going to create passive income, real estate was the thing that made the most sense. It was just one of those asset classes that I could understand. I'm not a super creative guy, but I am a pretty good executor. If you give me a task, I'm going to figure out how to do it. So for me, real estate was just numbers. So yeah, it made sense. So that was the original path, and we got started, and it was all side hustle for quite some time. We got started buying what you guys are doing, not turnkey, but residential multifamily. So we were doing duplexes in the town that I grew up in, or the town that I lived in Saratoga County in upstate New York. And very quickly I realized it wasn't scalable. It wasn't what I wanted to do long term. I mean, what really happened, Shecky, is I realized I hated the operational side. Like, I didn't mind finding the deals and the underwriting, that piece of it. I liked the structure of the deal. I hated the operational piece. Even in most of our systems, we had down pretty well: plumbing, electrician, that kind of stuff, just the day-to-day management. But the piece that I really despised was just the managing of the people. Like, the operation aspect of it, for me, just wasn't my strong suit. So what we ended up doing, and this was kind of how we got into, commercial real estate, and then self-storage is kind of the next step, is we sold what we had. I have one duplex left. Actually, my brother lives in it. And I just moved, so I might be selling that one, and he's going to have to find a different place. But
bro, if you're listening, at least you got some warning.
Right.
Yeah,
I'll give him a heads up.
Yeah.
But we ended up selling those, and honestly, there was a podcast I listened to, or I read it. I don't really know where I got this, but there was a quote that basically said, "Big deals and small deals are the same amount of work. You just make less money in small deals." And I said, okay, let's get into commercial multifamily. And so did a whole bunch of homework, and how it started for me was I cold called a guy that I had gone to church with growing up. He owned a construction company called Buck Construction. And that company, he had done all kinds of development of multifamily over the years. And I called him and said, hey, the patriarch of the family is Steve. I called Steve and said, hey, it's Kris Benson. Good to hear from you. I want to build commercial multifamily apartments. I got a little bit of money. What do you got? And, long story short, what basically happened was he had a meeting with one of the municipalities in a town not too far from where I grew up. And there was a piece of land they wanted to develop, and we ended up building a 64-unit apartment complex.
Sweet.
And for me, Shecky, that was the beginning of kind of the light bulbs going off to say, oh, this is how you make money in real estate. It was the beginning of that, to understand how I could do this and make it scalable for the long term. So we ended up building those apartments, and it's been a fantastic project. And to be honest, I put most of the credit with Steve. If I didn't have a partner like him, I was, knowing what I know now, I'm not sure I would have done the deal then, but I was naive, and it was a great opportunity. And then, so what ended up happening was we halfway through building those properties, one of my good friends that I grew up with was syndicating a condo project in South Boston. And when I learned what syndication was, where people were basically raising private equity, that's when the real light bulbs went off for me. I said, okay, that's what I do, right? I'm a salesperson, and I love the asset class, and there's interest in people investing in real estate. So my original path was I was going to go build my own multifamily and just raise money from other people. And very quickly, I realized the operational expertise that needed to be had for running those multifamily projects, I didn't have, right? I knew enough to be dangerous, but I certainly was not a 20+ year operator in the space. So I started partnering with operators. Basically, I went out to operators and said, hey, I can raise some equity. And in return for that, I want some back-end ownership on the properties. And so that's what we did. We raised a fair amount of equity for multiple operators. We worked with 3 multifamily operators across the US, investing primarily in primary markets. And in return, I was earning back-end ownership on those properties. And that worked really well. So that was sort of my path to financial independence. Leaving my job was I had a model that I could scale, and I had an investor base that was growing organically. And then, I'm sorry I'm talking so long, but this is the last step. This is how I got
started. It's great. I love to hear the whole journey, and I think the listeners do too. It's fantastic. Just roll with it.
Yeah, so this is the last step. This gets me to storage, and then we can talk about storage. So about 3 years ago, maybe a little bit longer now, maybe it's 4. Um, so one of the operators came to me and said, "Hey, we're done buying in this market." I said, "What are you talking about?" And they said, "Cap rates have compressed to a place where we don't think there's enough value in the space. So we're going to stop, and we're going to wait till the next market correction, and we'll have a whole bunch of dry powder sitting there, so we sweep up the blood in the streets." And, they're an organization with more than $1 billion under management, so they can afford to wait. And they bought one property, but it opened my eyes to say, maybe I should look at some other asset classes. And so I did some homework and fell in love with self-storage. There were really 3 reasons I loved it, and I'd be happy to go through those with you. When I started, I basically did the same thing with storage. I started going out and meeting with operators and saying, "Hey, I can raise a little bit of equity. I'd like to get into this space, and do you need help?" And I met with a bunch of them. The one that I fell in love with was Reliant, and Reliant Real Estate is a company out of Roswell, Georgia, and the guy who runs it is a guy by the name of Todd Allen. And in my experience, Shecky, investing with the people is probably a little bit more important than the properties themselves. Most of the time, if you have great people, the rest takes care of itself. Things are going to go well and poor in real estate, but that's kind of how I got connected with Todd, first as an investor. And then about 2 years ago, Todd and I had a discussion where he needed some help raising equity. And that at that point in my life, that's what I was doing. And so there was an opportunity for a partnership. And so we've joined up, and the rest is not quite history, but we're getting there.
It's history in the making.
That's what we're doing. You got it.
That's a great frickin' story. I love it, because you're a guy that not everybody is as bold as you are in making the moves, but it's interesting to me that, like, my editorial comment of your whole journey is more that you did it right. Like, you not only saw the opportunity and went for it, but you methodically studied, and you learned, especially with your sales background, you learned how to play to your strengths. Mm-hmm. There are so many people in this world that want to be entrepreneurs and don't really quite understand what they're getting into and don't really play to their strengths. And so kudos to you for the way that the journey unfolded. I think you were very smart and calculated about the way that you did that. So I think it's fantastic.
I'd like to tell you that I had that all planned, but honestly, like, the best opportunities in my career, whether it's entrepreneurially or job-wise, have always been things that have kind of shown up, and I've been willing to take the jump in. And I appreciate you saying I've been bold, but those decisions aren't easy, right? I'm not pretending that, I was like, yep, this is the way I'm going to go. I vacillated a ton and still do. I still have sleepless nights where it's like, are you doing the right thing? And I think that's part of the entrepreneurial journey. But the thing that if I could share anything with the listeners, is the critical part is you only learn when you're in it, right? And so you can educate, you can read, you can talk to people, you can network, but you're really going to learn when you step into the fray, right? And there's another great quote that I love is, to take the island, you got to burn the boats. And my wife basically said, hey, stop. Like, you can't do more than one thing really well. What's the worst that can happen? And, I could think of quite a few things that seemed pretty bad. Yeah. But that's ultimately it. I think Tony Robbins says the burn the boats quote, and it's a big one, right? When you have no other choice, if that's what you're doing, you're going to get better at it. And so that's the thing that my career and still to this day, even within Reliant, we're always pushing to what the next opportunity is and where we think it's, going to go. And sometimes we're right, sometimes we're wrong, but you're not going to learn until you're in it. I think too many people, like you said, want to be entrepreneurial, but they want to, it's death by analysis. They just spend so much time educating, and there's value in that for sure, but there has to be a moment where you jump in.
Yeah, there is. And my background coming from the digital marketing world, obviously the internet is full of so many self-proclaimed gurus.
Sure.
And Jack and I made a decision when we started our company that we specifically did not want to be gurus. I feel like there's a lot of bad information out there. And I think, the other thing that you said that I think is key is, if I can get woo-woo on you just for a minute, from a spiritual standpoint, because you said, look, things just showed up for me. And there are a lot of people that are not in tune with that. And they think that everything is just completely random and that nothing happens for a reason. I'm not one of those ones that's all the way on the other end of the spectrum that says everything happens for a reason. But I do think that it's really, really important to look at opportunities as they arise and say, why is this coming into my life? Why is this coming into my consciousness? And to be able to look and analyze and say, is this something meaningful or not? Rather than just calling it some random circumstance. So I give you props for doing that. And I think that's an important piece of growth, not just as an entrepreneur, but growth as an individual. And, it makes you smarter, it makes you stronger, and it strengthens the intuition muscle, which is important.
I think, you bring up a good point. And I think when you talk about opportunities that get presented, my success thus far is attributed much to the partners that I've had along the way and still to this day. But secondly, the other thing that I'm not afraid to do is go ask. And that's a key piece that, even with my kids, I try to tell, like, look, you're not going to get anything unless you ask for it. Right. And that's a sales thing that, I know my personality and not everybody has that. But honestly, like, the reason we built a 64 unit apartment complex, my first foray into commercial real estate, was I called a guy I hadn't talked to in 15 years. Right. And it's not like our families were really close. I just knew him and I knew he'd take my phone call. Right. The reason I'm at Reliant or started investing with them before I joined them was because I took the self-storage operator list that comes out every year and ranks the top 100 self-storage operators and called them and said, hey, I'm raising money. If you need equity, I can help. I just want some ownership and I want to come meet you. And that was what made the relationship with Reliant. And obviously now I'm here. I mean, I've relocated my family to Roswell. We're all in, but that opportunity doesn't exist without that first step. And then to your point, being able to identify, hey, there is an opportunity here. Let's jump. I think that's the critical piece that a lot of people miss. Because like you, I'm sure I get a lot of questions like, hey, how did you do this? And, you have to be able to identify first, but then be willing to take that first step.
Yeah, for sure. And, learning what we've learned, I agree with you, by the way, 100% on the people aspect. It's, that's 90% of it. I mean, it's 10% knowledge and execution, all that, but the people that you're involved with and the work ethic that they have and the goals and dreams and how they treat you and who you do business with, that's most of it. There's a lot of not so great operators out there, as we all know, but there are some darn good ones. And I agree with you. I could never be in the position that I'm in now without my business partner. We had a very, very rocky start initially, but we toughed it out and we just have an incredible relationship. And I'm grateful for that every single day, because it really makes a difference when you come to work in the morning and, what are we doing here? What are our goals? Sort of the bigger picture.
This is how we look at it. And then we can actually talk about self-storage at some point.
Yeah, we'll eventually get there.
The thing how I sort of perceive my career, right? And I'm 39, right? So I'm, arguably halfway. From my perspective, yes, I hope to make money, right? I mean, everybody wants to, I'm profit motivated, but I don't think I'm greedy. But the piece that I look back on is when I'm done in 20 years or 10 years or whenever I say, hey, I've accomplished what I want to accomplish, what I want to look back is the relationship piece. Like that's the only thing that matters, right? Is that the time that you spend, yes, maybe you make some money, but as you get older, the money matters less. The piece that really is valuable to me is when I'm done, can I look back and say, hey, that was fun. And two, did I do it with people that I really enjoyed? Like you said, have a common goal, vision, culture, whatever it is that you're trying to build. And for me, that's my motivator, right? Is when I'm done, I don't want to be in a position where maybe I made a ton of money, but not happy with who I did it with or how we did it.
Yeah.
I'd much rather make no money and then 20 years from now say, but I have all these relationships that I can take, to my grave. So I think that's something that, it's unfortunate, or at least for me, I didn't realize these things until, probably I was in my 30s or maybe late 20s, where it was like, oh, okay, I've made money. That doesn't really do anything. Now what? Like, what do you seek now?
Yeah, 100%. Sadly for myself, I probably didn't realize that till I was in my 50s. Mm-hmm. So, but it's key. And, even when you get to a point where you want to semi-retire or retire or whatever you want to call it, or slow down, let's just use the words, and not be working long weeks and all that kind of stuff. It's also not just who you did business with getting there, but what's the quality of your life now? What are the relationships that you were able to build over those years? Friendships, it's not just necessarily spouses and kids, but it's friendships. And, in my world, a lot of business relationships, I've been blessed, have turned into some really amazing friendships. Mm-hmm. And I love when that happens. And I think that's what life is all about, really. I mean, that's the secret sauce right there. And I think I'm 100% in agreement with you. So anyway, let's talk, because we're going to run out of time here. I know I said to you earlier, we kind of
would you call it woo-hoo?
Woo-woo.
Woo-woo. No more woo-woo.
Yeah.
That's the first I've ever heard that.
Yeah. Anyway.
Talking the asset class now.
Yeah. But I want to talk about self-storage. You hinted, let's start here, that there were 3 main reasons why you got into self-storage. Let's roll through all 3 of those.
Yeah. So understand my background, right? So I was investing in multifamily, which is sort of the sexy asset class that everybody loves, right? Everybody wants to talk about commercial multifamily, and it's fantastic. I think it's a bit overvalued right now, and there'll be a correction. But for me, where I start always is the historical data. I'm a big believer that, what's happened historically is probably going to be a pretty good predictor of what's going to happen in the future. So there's a data set that I really like that I can send to you. You can put in the show notes. It's the National Association of REIT. I think it's REIT.com, but I can send it to you after.
Yeah, please.
There's 25 years of data of all the publicly traded REITs across all asset classes. So if there is a REIT that has that's publicly traded, the data's there. So you can look at timber REITs, office, retail, apartments, storage. And so that's what I was using as sort of my apples to apples comparator. So in the last 25 years, storage performed at just under 17% a year.
Nice.
So when you compare that to what I was investing in, which was apartments was just under 13%, which was fantastic, right? But storage outperformed, which I thought was pretty interesting. And then the second thing that I always look to is, after the returns, I want to know what's going to happen in the next downturn. So in the last recession, how did it perform? And so if you look at that same data set in 2007, 8, and 9, storage lost less than 4% of the value in the publicly traded space.
Wow.
And when you compare that to apartments, it was just under 7. So apartments fared pretty well. Just to give you a baseline, the S&P 500 in that same time frame, 2007, 8, and 9, lost just over 22%.
Yeah.
So, you have this fantastic upside, these great returns, and then this downside protection. And the hypothesis with storage as to why that happens is, it's kind of like workforce housing, right? Where you catch people on the way up, and when times are good, people buy stuff and they put it in storage. And when times are bad and they're downsizing, they don't get rid of their stuff. They may downsize, but there's this mentality, at least in America, where no one gets rid of anything. I mean, Shecky, I can't tell you how many times I've been in a storage unit where the stuff in the unit is worth less than 1 month's rent. But for whatever reason, they're paying to have that stuff there. So that's reason number 2, right? You got returns, you got some downside protection. And then the third thing, and this is really the reason why, I've partnered with Reliant and just kind of strapped my horse to their wagon, is the market itself. There's about 25% of the market that is owned by 6 publicly traded REITs. 5 of them are REITs. 1 of them is just a publicly traded company. So if your listeners are driving down a highway right now, just start looking off the exit ramps. Companies like Extra Space, Public Storage, CubeSmart, those are the big REITs in the space. And then the 6th company is U-Haul. So everybody knows who U-Haul is, and they have a pretty substantial self-storage portfolio. So they own 25% of the market. The other 75% is all over the board. So there's a huge consolidation opportunity where institutional capital has not yet infiltrated to the degree that it has in, for example, multifamily in storage. So for an operator like us, there's a great opportunity to continue finding value in the market and consolidate those properties in a roll-up strategy, right? If your listeners are familiar with a private equity play, it's basically finding those mom and pop operators, rolling it up into one operational efficient model. And then you have a monster portfolio that potentially you can look to sell. So for me, those are the 3 reasons, really: the performance, the downside protection, and then sort of that the opportunity around the consolidation. And that's what we're seeing in the marketplace. There's still a ton of, what I would call a mom and pop operator is maybe 1 or 2 sites where we can go in and create value. So that's the pillars of why I like self-storage.
Wow, you articulated that very well. And I'm surprised because there was an element that I thought was going to be one of the 3 that's not in there. So
talking about the management of them.
Well, yeah. So this is what's interesting to me. I mean, obviously, we operate, down in the trenches with mostly single family homes, and, property management is the biggest effort. And I start thinking to myself, okay, if you've got a self-storage place, the couch that's sitting in there is never going to damage the property. There's some that I know that are climate controlled, but you don't really have to provide all these, quote unquote, basic needs for the inanimate objects that are living inside of that storage space. I mean, there's no like, what's the word I'm looking for? Equal opportunity laws or any of that kind of stuff. I mean, there's probably equal opportunity in terms of, who you're renting to, the actual human being, but the human being is not living there. It's just the human being stuff. And I think from a management standpoint, it's an incredibly clean operation. I mean, you have one older dude or an older couple hanging out, and everything else is just kind of locked up, and all they're doing is letting people in and out. And now there's all kinds of technology with security to let people in and out. I mean, it's a really, really simple operation.
Well, I would agree with you on the tenant side, like actual maintenance of the unit, right? And the turnover is you sweep it out, right? You're not painting and carpets.
Yeah, exactly.
It is a very operationally intensive business. So we're vertically integrated, meaning we're buying the properties and then we're running them as well. We are our own management company. So we have 48 properties, 49 actually. We close on one Thursday. So we have 49 properties across 7 states. We have 160 employees, and the majority of them are running the facilities. The facility management is the critical part of us driving revenues. Keep in mind that in storage, the leases are 30 days. So different than most residential models where, I have a tenant for 12 months. And in that 12 months, I pretty much have them locked up. They maybe have some outs in their lease, but they're not going anywhere. With storage, the good and bad of 30 days is you can really affect revenue very quickly to the good, because you could raise rents literally if you wanted every month. Now we'd lose all our tenants, but you can change the revenue cycle very quickly. The downside is occupancy can drop very quickly as well, right? You have these seasonal patterns where, maybe you're in a market where there's a university. So when students go home for the summer, storage occupancy, skyrockets, right? When students come back in the fall, all of a sudden you have this big dump out, right? So it's really the management of that revenue cycle. And what I would say is the more operationally intense piece is the marketing, the grassroots marketing we're doing to try to drive occupancy into the facility. And that's the big, I think, misnomer. And it depends on your model, right? I mean, if you're using your own money and you're trying to just deploy it with a strong cap rate where, you can go out and run 2 or 3 facilities, you can probably do that. Our model is built around investor equity. So we're trying to drive returns, and, how we do that is growing net operating income. And so to do that, we have to constantly be churning. So it's a big, there's a big operational expertise to it, but your points about like the maintenance and the cleanup, yeah, for the most part, I mean, unless you have like, rodent issues or pest or a flood or something along those lines, the maintenance of the actual unit is very limited.
Yeah. Well, just doing the math, I mean, you said you've got, 46, 48 properties and about 160. So it's roughly 3 employees per operation, roughly.
Yeah, we have, typically you have a manager, a site manager, and an assistant site manager. The site manager usually lives on site. So we try to build an apartment on all our facilities.
Oh, nice.
So they live there. It's perceived safety from the tenant's perspective, and it's kind of 24/7 access for them. And then we obviously have an operational infrastructure that supports the team. So, you have market managers who may have 5 or 6 sites each reporting to them. And, we have in our corporate office here in Roswell, we have a director of field operations and a director of ops that everybody rolls up to. So the majority of that 160 employees, call it 140, manage the sites. And then, we have, the normal accounting, HR, executive function in the office here in Roswell.
But I would think, based on what you just said too, that the marketing team is pretty crucial.
Yeah, there's no doubt. I mean, that's been one of the big shifts in storage in the last 5 years, is how you get tenants, right? I mean, it used to be literally like yellow pages, Now the REITs, the big self-storage REITs are spending a ton of money on SEO and pay-per-click ads and social media. And so we've had to evolve with that, and we still are. We have a consultant that's working with us right now on some interesting social media campaigns around, geofencing of potential customers and trying to create positive impressions around the brand. So that's the part that's interesting. It's a very dynamic asset class.
Yeah, it's interesting that you say that, because obviously I alluded to my background, but it's it's weird how I'm in the real estate business, but I'm only in the real estate business as a result of my marketing expertise, or at least in this business. I will always be an investor, but I'm just talking about in the operation that I have with Jack.
Sure.
So it's marketing to me is everything, and it has changed drastically over the last decade, and even in the last 5 years. I mean, it seems to change every 30 minutes.
Mm-hmm.
And, if you're on Facebook or doing search engine optimization, there's new rules, new laws, new ways of doing things, hundreds of different ad networks. It's very, very, very complex. And it's one of those things that you have to pretty much be on top of 24/7, or you're going to be left behind, because there's a lot of other sharp people out there that are on top of it 24/7. And if you're not, they're just going to eat your lunch. So
Yep.
it's just the way it has to be. So it's really interesting how growing a business just in general has shifted so much. The good news is, for guys like you and myself, one of the things I love about being in the real estate and working with investors per se is that there is still such a human element, and there is still such an element of trust and doing business the right way, that when you do that with anyone in our capacity, that spreads and they tell their other investor friends. And we've grown much of our business organically, even though we do have good digital marketing. And I would venture to say, based on you going out and raising capital, I would assume that much of the newer capital that you raise is based on good established previous relationships and a good track record with some of those people previously.
Yeah, I mean, I think it's a balance. For us, the amount that we're raising continues to grow year by year. So, last year we deployed just under 40 million in equity and bought about 100 million in self-storage facilities. This year We're in the midst of raising a $50 million fund. When we complete that, this year we'll be closer to 60 million, right? So we're always growing that base. And, a big part of our investor base has always been that individual high net worth accredited investor. And you're right, those are the ones that are growing organically. I think as you start to grow that capital need though, and your equity stack becomes larger, you need to go to people with bigger pocketbooks, right? Just because, managing 1,000 retail investors is a lot of brain damage. There's a lot of, that's 1,000 people, each with their own things and, changing addresses. There's just a lot of administrative. And so Shecky, I think back to my original comment of big deals and small deals are the same amount of work. You just make less money. That's true with investors too, right? So
yeah.
And this isn't to sound crass, but if you invest $50,000 or $5 million, we spend the same amount of time with you. It's just the 5 million buys us a lot more property than the 50,000. And so it's a balance for us, right? It's a balance of finding, continuing to grow the individual investor while also scaling up, so that if we find opportunities, we can go out and capitalize on them. Just to give you a quick story, we just met with 2 of the largest university endowments in the world. Do you have any idea how much money the top 20 university endowments manage in the United States? Just take a guess.
Top being aggregate, you're asking?
Yeah, so each university has an endowment. I'm going to give you 20 of them in the United States. Guess how much money they have in their endowments?
I would probably say $500 million.
500 billion with a B. That is $1/2 trillion.
Oh my God.
So we met with Harvard and Yale. Harvard manages 35, or I think it's 38 now, $38 billion in their endowment. And Yale, who's number 2, manages just under 30. Wow. So it is insane how much money universities, and look, the endowment runs, in both those institutions, more than 1/3 of their operating budget. So they have a really unique investment horizon, how they look at their investments, because they believe the institution will exist forever, right? Then Yale's never going to go away. Harvard's never going to go away. And so the endowment has to exist forever. They're not in it to turn the money. They can't take the money back. What they need is the returns every year to help fund, professor salaries and capital expenditures on the campus. So it's a really interesting journey.
That's an interesting model. My first thought was, first of all, the numbers blow me away. But if you've got that much money under management, it should be giving you 100% of your operating costs, not 30%. Those are some gargantuan numbers.
Yeah, well, you'll have to talk to the university about how they dole out the endowment, but it is an incredible. When you walk into the Yale office and they're across from a fried chicken shop in downtown New Haven, and you're really, this is the office that manages $30 billion, but really interesting guys and gals. And it's a fun conversation. We'll see where it goes.
Yeah, that's great. So you approach them obviously about investing with you guys.
Cold calling, Shecky.
Love it.
Cold calling.
Love it.
Cold call.
I've always have a lot of respect for a true salesman. I think it's great. So we have to take a quick break just to let Nicole jump in for the home run of the week. So we're going to do that right now.
Hi, this is Nicole, your Director of Investor Relations at High Return Real Estate. This single-family home on Eugene Street is the perfect property to add to your portfolio. We acquired it for a fantastic price, and the rehab went off without a hitch. After all expenses, the cash-on-cash ROI of this one is nearly 12%. And remember, like all of the properties you buy from us, you'll be able to see the full scope of repairs, the third-party inspection reports, and you'll get our unbeatable roof to foundation warranty. This one is truly a home run. Just send me an email at homerun@highreturnrealestate.com. That's homerun@highreturnrealestate.com, and I'll be happy to send you the full investor folder. Talk to you soon.
Thank you, Nicole. That's great. So I've got a couple more questions for you before we wrap up, Kris. So,
Sure.
Being in the space that we're in, which is very similar, there's a lot of stuff that I know now that I didn't know 3 years ago when we started, right? Mm-hmm. So I just want to look at the little window of self-storage because that's mostly what we're focused on today. So now that you have moved to Roswell, the Georgia one, not the UFO one, by the way.
Right.
People that are listening.
Outside of Atlanta, not New Mexico.
Yeah, exactly.
Don't come here to storm Area 51. I'm not.
Exactly. Yeah. Stay away. What is it that you know now that you wish you would have known when you started in the self-storage space?
That's a good question. So much. I mean, think about it, right? Like I knew real estate or, I'm not an expert. I know everybody likes to portray you as one, but I feel like there's always so much that's happening in the asset class. I understood real estate. What I didn't understand is some of the operational pieces, what we talked about, the complexities of managing the facility, right? Because I was coming from a background of multifamily where literally get the lease and you're good. You can count on that revenue for 12 months, for the most part. With storage, it's a much more dynamic revenue cycle. And, there's seasonality. Those are the detail pieces that I didn't really understand. I mean, I could read about it. There's a great resource that your listeners can tap into. It's called the Self-Storage Almanac. There's a company called Minico, which is like an industry newsletter, and they put out an annual self-storage almanac. I think they're in year 25, but that's sort of the industry standard on what's happening in the industry. So I would encourage people, if they want more information on storage, it's a great place to start. But I could read about what those operational issues were, but understanding how difficult it is to manage those revenue cycles, I think is probably the biggest piece. And then secondly, in storage in 2017 and 2018, the industry has delivered the most new net rentable square footage in the history of the asset class. So just like anything, when someone makes money in it, there's usually going to be a whole bunch of people who want to do it with you. And so storage is no different. There's been a big development cycle. It's going to, or projected to tail off here at the end of this year. The good news is that the lease up has supported it. There's been some markets that have certainly been oversupplied, but also understanding kind of the supply demand aspects of storage was something that I didn't really have a good indicator on or a good understanding of until I was in it.
Yeah, that's fabulous. And to your point earlier, like you don't really know until you do. and
that's where good partners come in, right, Shecky? Like you have somebody who can put their arm around you and be like, hey, you need to think about it this way. Yeah, it's crucial. It's absolutely crucial. So this has been fantastic. I'm appreciative of the way you really shared all the kind of more things about this than really I had considered. Learned a lot from this, and I'm sure the listeners have too. If somebody wanted to find you, how would they go about doing that? Yeah, so there's a couple areas you can reach out. So we have a website that basically is built around educating on real estate, not necessarily storage. There are some storage components, but it's really for our investors who are interested in the asset class. And if you go to KrisBenson.com, and it's Kris with a K, so it's KrisBenson.com. Sure. There's a whole bunch of free content. You can go in there and learn, basically make yourself a dangerous real estate investor. And then, we have, if you're interested more about the company, you can go to ReliantInvestments.com, and that's plural. So Reliant Investments with an S. And then I'm pretty active on LinkedIn. So if you search Kris Benson Reliant, you'll find me, and happy to connect with you there. And we post a fair amount of stuff of what we're doing, what we're working on. And I think if you go to one of those three, you have a pretty good shot at connecting with us. Okay, great. I will put all those links in the show notes. And yeah, you're going to send me that other document that you said you were going to send, and I will. Yeah, the National Association of REIT Data.
Yeah. And
Yep,
we'll,
absolutely.
if we can put a link to that in the show notes too, that would be fantastic. And
Be happy to.
that will give the listeners a really good, thorough education of what's going on here. Well, Kris, again, a million thanks. This has been great. I wish you the best of luck in your new home. And you're obviously going to kick ass. So, because I already see you're already kicking ass. So it's great. And I'm appreciative of the time you spent with us and for sharing much of your wisdom with us.
Well, I appreciate that. And thanks for the opportunity to chat with you. If you need anything else, by all means, reach out. Happy to connect.
Thanks a lot.